Hi, my name is Joe Gaudio. I own a financial planning firm here in Vancouver, Washington that goes by the name of JAG Financial, and I clear trades and compliance through LPL Financial, one of the largest independent broker-dealers in the United States. And that's for those of you who don't know me. My office is here in the beautiful Pacific Northwest, and as you can see, it's fall behind me, and it is tax year 2023. Why that's important is because I'm going to be talking to you today about a topic that can change over time, and that is something called a qualified charitable distribution. So, this is really an important tax strategy used for clients and could be useful for you as well. This strategy is applicable really I look for three characteristics to make this make sense. Number one, does the client have a qualified account, retirement, IRA, 401k, some other type of investment that is qualified? Number two, is the client charitably inclined? Do they typically give, to a charity, a church, an organization, some nonprofit, or do they have aspirations to do so at some point in the future? And then number three, are they over the age of 70 and a half? This strategy is designed for clients 70 and a half and older. So even if you're not 70 and a half at this point in time, really, as you kind of get closer to that, it's a strategy that we could start to look into a little more, you could look into. So the strategy goes a little bit something like this. There's something called a required minimum distribution that many of you may or may not be familiar with, but basically tax law states currently in 2023 that when you hit the age of 73, you're required to take money out of those qualified accounts, whether it's a 401k or an IRA or some other type of qualified account. So let's just say, for example, that you hit 73 and you're required to take out that year by the IRS code $10,000. But you're charitably inclined and you happen to give $10,000 a year to your church. Well, this strategy is really powerful because rather than give the $10,000 straight from your bank account to the church that's already been taxed, you can use a pre-tax asset like a 401k or an IRA. If that money is given from your IRA directly to the charity, which I do this all the time for clients, then you don't get the tax write-off of that, but you do not pay tax on that distribution. So that $10,000 distribution is non-taxable because it goes straight to a charity. If you take it out, and let's say you're in a 25% bracket, you would owe about $2,500 in tax on that money, therefore only getting the difference, which would be $7,500 to then give to your charity of choice. So this strategy is really important because that standard deduction that I alluded to earlier is now $27,700 per married couple. So unless you're going to give away more than that in any given year, you wouldn't benefit anymore, unfortunately, from giving $5,000 or $10,000 to your local charity or church or some other nonprofit organization. So this strategy, again called a Qualified Charitable Distribution, acronym is QCD, has been a really powerful strategy for clients of mine and maybe something that you should look into as well. Of course, this information is not intended to be any individual investment advice or tax advice. And I always say seek the professional advice of an accountant or your financial professional. So until next time, have a great day.